Crypto markets remain under pressure as funding markets are tight despite the end of the government shutdown last week. Volatility is rising as Fed speakers have become more hawkish and rate cut odds have been slashed below 50% for December. Investors reach for put hedges as BTC tests critical support near 90k. All this and more in this week's Crypto Options Unplugged. Welcome back to Crypto Options Unplugged, everyone. I'm Imran David from Options Insight, back in the studio with my friend Dave from FRNT. How's it going, man?
Yeah, I'm good. Yeah. Interesting week in markets.
We've got matching hoodies.
I know, matching hoodies. Yeah.
Remember, these are limited edition. Yeah. So, what are our thoughts? We're testing 90k, big level on Bitcoin. Now, This is the one we said if we broke that kind of 98 level, we were going to test this area.
I think KC8K is like the big support where we kind of broke up from in April when we had the sell off. So it feels horrible. Like it does.
Sentiment's pretty bad, right?
Sentiment's bad, and we can get into some of the sort of macro stuff. It does feel to me like there's some sort of flow out there. Whether that liquidation event from a few weeks ago, whether someone is in pain and they're having to liquidate a portfolio or deleverage, it has that feel to it. But
it might also be. Remember, we had a lot of demand from like these treasury companies and the like, right?
Yeah.
And the ETF inflows, and they've all reversed. Right, the treasury companies aren't buying, right? Yeah. And the ETFs are now net selling. Yeah. Right? About 4 billions left the ETFs.
Yeah.
Right?
Like that money's come out very quickly.
So then if there's no marginal buyer anymore, and the kind of whoever was selling into that flow before is still doing it. Yeah. That's where we are, I guess.
Yeah.
Right?
I guess it just feels like, particularly just looking at price action, it feels like in the US session is when there's a seller. Like, we kind of seem to do all right. I mean, let's see how we go today. We've bounced a bit, but we tend to bounce in Asia and Europe, and then the US come in and there's this just persistent selling. Mm-hmm. So that's kind of interesting. But yeah, I think to your point, like if we, take away those kind of conspiracies, and maybe we will see a dead body float to the surface. But look, you've had quite a lot of demand destruction and capital destruction from that liquidation event. Whales have been constantly selling in a way, so you're still seeing that, and then you're seeing outflows. So the supply side is quite heavy. The demand side, as I say, is pretty weak. So you've got that kind of imbalance. And then over the last week or so, equities have started to roll over, which I don't think there's anything too much behind that. But obviously, we'll question AI valuations and. Like you mentioned earlier, there was that car crash interview really with Sam Altman and around the stuff.
Yeah, that was a bit scary, right? Yeah. Sam Altman being asked whether he's going to meet his obligations with all this kind of interconnectedness within the AI space and over $1 trillion worth of commitments in what he's going to invest in other companies. It's like, where's that money coming from? And he couldn't really give a straight answer, right?
So I mean, for me, it's classic as well, though. There's a lot of bears out there that are always looking for the next blow up. So AI has become the thing. And I still think, don't get me wrong, there's going to be corrections and we will have, periods of frothiness and you could argue that we were there with AI tech stocks and whatnot. I still think we're in an exponential trend, and we say again, markets tend to like mean reversion, right? But we're in an exponential secular trend that we're all still struggling to get our heads around, what that looks like. And obviously, probably the biggest news this week, other than non-farm payrolls, and now obviously we can get the data releases.
It's due on Thursday.
Yeah, but we get Nvidia results on Wednesday.
Yeah,
and that feels quite key because if it's weak, then all the bears are going to be out roaring, saying, "We told you this was a bubble. We told you it was a bubble." If it's strong, it's like, oh, maybe this is just an exponential trend, and there's kind of no stopping this train. So I still feel quite relaxed around that. just given that, say, exponential trend. But yeah, fine that we have some sort of, froth comes off the top of that market. Been on a really good run, but I mean the equity correction is pretty minimal. We're not
highs were around what 69.50 ish, and we're about 300 points off that.
Yeah,
it's about 5% pullback.
It's like nothing.
Yeah. Fed cuts. Are we going to get them in December or not?
I actually think it depends on the data. Like markets kind of essentially priced them out pretty much. I found the Fed weird that they've had no data, and they've kind of decided that after doing risk management cuts, they've decided now the risk management option is to not do anything. Whereas I would have said, if you felt that you're on a path, back in September they cut.
Mm-hmm.
October they cut, I think. If you're on that path of cutting because of you're thinking, right, we still see the downside risk to employment as being greater than the upside risk to inflation, that's why we've cut, and that's why we're forecasting back in September to cut again in December, and they kind of dress those cuts up as risk management cuts. It's like, what, you haven't had any data to at the moment to start thinking the other way. So I actually kind of feel there's a little bit of the market who is still concerned about the impact, this kind of growth slowdown and these lagged employment impacts coming through. There's still like kind of those recessionary flickers out there. I'm actually not in that camp in terms of I still think when you're running fiscal deficits north of 6%, we're slowing growth, not collapsing growth. But I still think there's a little bit of that fear. And now, if the Fed are going to be perceived to be behind the curve on that, then again, that's just adding to the sense of caution and nervousness in this market. But we've got data this week, non-farm payrolls.
I've got a theory on this.
That could change things quite quickly in this market, by the way. So it's going to be interesting.
I've got a theory on why they pivoted a bit hawkish in their wording, right? Because remember, it's just wording, right?
Yeah.
But when we were fully pricing in the December cut and maybe some more, right? I think there was definitely an element of, has the Fed lost all credibility? They're just doing what Trump says, basically, right? And so I feel like that's not good for the long end of the bond market, right? If we think the Fed's lost credibility and they don't care about inflation, there's a risk that long end yields can spike and that the house of cards falls down. So I feel like this kind of rhetoric, they might give us a cut anyway in December, but by at least appearing like they do care about inflation, like they're not totally sure, it kind of starts to stabilize the long end a little bit, right?
Yeah.
And how we've always talked about how really it all matters. The biggest thing is what happens to the long end of the bond market, right? Yeah. So I feel like if you look at the volatility of the long end of the bond market, it's collapsed. Just doesn't move, right?
Yeah.
So whatever they've done, they've taken the vol out of that, which is, I think, their actual ultimate goal.
But part of that is this what we call Treasury QE, where Besant has kind of, again, continues to front load the issuance at the front end, and less coupon issuance. So I think that's probably helped. But like, I guess to kind of counter your point, like from the cut in September, I think when they cut in September, we were at 4%. We kind of jumped up to like 4.10, and then by the time they cut in October, we were back down to 4%, and then we jumped again like above. I think we got to like 4.15 or something in the 10-year, and now we're back below 4.10. So yeah, like you say, like yields have been really stable. Maybe that is them doing a good job, but it also, it wasn't like the bond market was pressuring them into like a hawkish kind of turn or whatever. But
no, I think it's more preempting.
Just preempting that.
Yeah.
But like,
because how gold was going ballistic, right?
Yeah.
Gold going ballistic. Why? Because people are opting for gold rather than treasuries, right?
Yeah.
So I kind of feel like that whole story, was a risk to the bond market, right?
Yeah.
Because I know macro investors, a very famous one, Darius Dale, is a friend of mine, and he made a big pivot this year, telling his investors to own gold rather than treasuries. Yeah. So it's like the asset allocation framework for a macro portfolio, rather than being 60-40 bonds, equities. He's like, no, we're going to go equities, gold, and crypto and Bitcoin, basically, right? And bonds aren't even featuring in there. Yeah. Even if I'm defensive, I ain't owning bonds, right? So if there's more and more people who look at gold going parabolic, look at treasuries going nowhere, there is a risk that a large amount of AUM that's out there decides, yeah, why am I in treasuries here? Right? They could get seized see what happened to Russia. They can get seized. They've got no price appreciation, right? And I'm better off holding other safe havens. Right?
Yeah, that move is like, that's been underway. And I mean, yeah, God, if you bought treasuries in 2020, when rates were at zero, I can't even remember where 10-year treasuries were trading then, but like, you've just lost money on that, and you're probably looking at gold and Bitcoin and going, why was I long treasuries? It's cost me a fortune.
Yeah.
And ultimately, I do think over time, that's and because the other thing you've got with treasuries is they pay you in fiat, which is also going, worthless.
But the reason to own them is because they offer you some risk-off diversification, but that didn't happen in 2022, right?
Yeah, exactly.
In 2022, bonds and equity sold off together, which was the problem, right?
Because I think people are starting to question like the debt and debt sustainability, and ultimately, like I would never own bonds and government bonds. They're just the risk reward, like the risk return on them is not good. Like on a vol adjusted basis, it's not good. And again, that's when people say about Bitcoin's volatility. Actually, returns on a vol adjusted basis for Bitcoin is still one of the best assets out there because the upside's been has rewards you like for that volatility. But yeah, like for what will happen for me is that again. And actually, we should talk about Japan, but like, the Bank of Japan owns 50% of the Japanese bond market, government bond market. I think the ECB is at around between 20 to 30% of the European bond market. The Fed are around 20% of the Treasury market. All of those numbers are going up. They're all going up, and it's that Japanification of the Western world now. A short-term concern for me is what's going on in Japan because Japanese yields are starting to spike again. We're also seeing that here in the UK. So are we going to see, again, like global bond turbulence? And when we get that spike in bond volatility, that's bad for liquidity, and that'll be another negative short-term for risk and for Bitcoin and crypto. But you've got Japan now, already running like 230% debt GDP. The new PM's gone in and she's going to do another fiscal package, but they had like negative Q3 growth of like negative 1.8% came out the other day. So they've got this. They've got growth sweep, but then they've still got this inflation problem. The BOJ want to hike. She wants to do the fiscal, which is coming. So now that's putting their bond market under pressure, and now the Bank of Japan are in a really difficult position, like because they've already said that that they would act to intervene if yields start to if that volatility.
I mean, if the currency starts going down too much.
Well, no. If JGB yields start to spike out of control, then they will actually sort of step up pace of bond buying. Okay. And essentially,
if they do that, the currency goes down.
Then the currency goes. So they're gonna be in a space of what do we like? Pick one. Like they're going to have to either pick bond market or the currency, and as I always say, it's always the currency that is the escape valve.
On that point,
I don't see any way out of this. By the way, I don't see any way out of it. They're just going to hope that the market, the bond vigilantes don't come out targeting them. But right now, treasuries are well behaved, so that's.
You mentioned UK. We got the budget coming up in a week.
Yeah. I
don't see any good choices for the UK either, right?
No.
So sterling, I think sterling's a slot here, personally, right?
Yeah. Like this is like from a long, like short term, right to be cautious still, I think. Long term, all of this just plays out like so brilliantly well because debt-based fiat economies can only survive on more debt. And so politicians going in, and even those that want to kind of get deficits under control, quite quickly growth starts to fall away and they're back into spending mode. And then the bond market comes under pressure, yields are spiking, and then central banks are kind of forced really to intervene with some sort of yield curve control or to maintain that. And eventually it all means that it all ends up on the balance sheet of the central banks. Speaking of which, in terms of where we're at, we've spoken about the RRP, the reverse repo facility, like being drawn down. And that's been what's supporting risk and everything going up. And then I kind of felt once that hit zero, and it's basically at zero now, there were sufficient excess reserves in the system that would essentially fund that Treasury issuance, if you like, and keep plenty of liquidity in the system. It feels like we've hit, we've hit levels of where excess reserves have come down sufficiently that it's obviously causing these funding issues. Now, the Fed's John Williams, he's spoken about going from abundant to ample, and when we go from abundant reserves to ample reserves, we'll need to basically start expanding the Fed's balance sheet again. And everyone's gonna get into it, but it's not QE. It's not QE technically, it's what I call a not QE. What he means is they'll start supplying liquidity into the front end through some sort of monetary operation to essentially support the front end, ensure sufficient liquidity and funding so that we don't have these repo sort of funding spikes and short rates going to a level that are inconsistent where the Fed funds is trying to set rates at. So he's kind of alluded to that point is coming soon.
Well, in the next couple of weeks.
Well, we don't know, but my thought was that given the stress that we've already got, obviously as we get into year end and banks window dress balance sheets and all that, and you tend to have liquidity really dries up into year end. I think they're potentially looking at that thinking we need to get ahead of that. So if we're going to do something, they're going to have to do something at some point, right? So they might, I think they're looking at that. He actually met with all the major banks last week to discuss these issues that are going on in funding markets. And I think that's also additionally spooking markets a little bit here. When you've got a Fed governor meeting with banks to go, what's going on? Like there's obviously concern there, right? And it's like, we thought there was a problem and now you've just confirmed there's a problem. So I think those things are weighing, but there is this liquidity issue. And again, it goes back to, right, you've got all of this Treasury supply and bill supply in the market from the massive deficits that the US are running. Someone's got to fund that, right? And we've had the RRP drawdown, which again, because there's all this excess cash where the Fed printed back in 2020, 21, that's now been drawn out and that's now tapped out. Now it's like, right, where's the next amount coming from? So the Fed ultimately are going to have to supply that liquidity. So in terms of where we're at, government shutdown ends, right? There's probably about 150, 200 billion excess in the TGA, the Treasury General account, that will start to get spent because now they can start funding operations in the government. So that will see excess reserves increase because that money essentially ends up back in the banking system, and that will ease liquidity. So my kind of playbook in my head from here, aware of short-term caution and just the negative, the bearish momentum, see big level 88k in Bitcoin. I actually think we're going to get a bounce over the next couple of weeks as that TGA money starts to flow and liquidity eases, and that probably takes Bitcoin back to 100k, like just over. We need to get back above 107k to really sort of stave off the bearish momentum. So until we really get there, you've still got to kind of think we're in this kind of bearish move. But that will ease some, and then obviously QT ends in December. And then see what the Fed do in terms of if they cut rates. But if the Fed don't come and do something on this not QE, then we'll quickly be back into a part, of funding stress, excess reserves in the banking system are depleted, and then the question becomes, do the Fed wait for the market to force their hand and we have a kind of mini repo sort of blow up? Equities dumping, Bitcoin dumping, and then the Fed go, right, oh shit, we need to act now? Or do they get ahead of that? Signs are that they might get ahead of that. If they do, then everything's going to rip. Like take away year end, which can be
we've seen that movie before, basically.
Yeah. So I think my kind of message, I guess, to everyone would be now is like, look, be really cautious, have your hedges in place. For sure, don't be a hero right now. I do think things will ease over the next sort of week or two as this TGA draws down, but that's not in and of itself going to be sufficient. But for all those who are talking that end of 4 year, the 4 year cycle, it's end of the bull market. I don't think so, because we're about to see the Fed we're about to see the Fed money printer get switched on over the next weeks or months, and that for me will take us in 2026. We'll see that kind of blow off top move where we hit silly levels in Bitcoin and across crypto. And on top of that, Besant and Trump are going to really goose this market into the midterms. So I actually think you'll see the economy performing, liquidity is going to be higher, Fed balance sheet increasing. So I'm still really...
You have to stay in the game.
You have to stay in the game, and I think 2026...
Don't have leverage again, right? I mean, this is the thing. Like, this is why I talk about hedges. This is why we say don't get over-levered, so you can stay in the game. Because it's hard to time these markets, right? If it was that easy to always time these markets, everyone would do it, right? In terms of my hedging, what I'm seeing in Vol, decent spike in Vol in the last week. Front ends up like 15, 20 vol points, which is significant. Bitcoin vol had got into the 30s, right? It's back to like 50 odd. Ethereum's trading a good 20, 25 over that, as it has done for ages now. Put skews back to around sort of 7, 8 in the front end for puts. So skew, is back for put premium, as clearly people are looking to the downside. I've had some November puts on, thank God. Did start to delta hedge them at 100k. Now that we got to 90k, I've unwound that and replaced it with a December put spread collar. So that's like buying a put spread and selling a call. So it's like 105k call and what is it? Something like an 85, 70 put spread, right? So I've got protection down to 70k. I don't mind overwriting my longs at 105, given that we're down here. Out to December, and that's kind of how I'm managing it, right? And I've monetized my put protection that I've had in November, basically. So that's how I've kind of played it. But speaking of hedging, I got to catch up this week with Sam Gaer, who is the CIO of Monarch Asset Management, and he's a big advocate of running hedges in the book against his directional strategy. So have a look what he had to say. Hey guys, it's Imran. I'm back from that 1 week out that I had in Miami. But today's special guest is CIO of Monarch Asset Management, Sam Gaer. How are you?
Good. How are you doing, Imran?
Good.
I'm thinking I may have bumped into you maybe in Miami last week. I was down there too. So.
Oh, were you? Oh, okay. Fine. Funny. It's a nice place. It was funny. The weather was really good, and then suddenly on Monday it like dropped like 10, 15 degrees. I don't know what happened, but then it was very strange, like being out there and suddenly you're wanting to wear like layers and stuff. But anyway, I had a good time. But a lot's been going on since I've been away. The Bitcoin market or the crypto market's kind of falling out of bed a little bit. So definitely want to sound you out on that one. But before we get into markets, why don't you tell us a little bit about kind of your background and kind of how you found yourself in this space?
Sure. Well, thank you. First of all, it's lovely to be here. I appreciate the invite. My career spans about 35 years. So when we say that Sam is an OG, it stands for old guy, not so much the other thing. But in all seriousness, I started my career as a floor trader, actually as a runner on the COMEX and NYMEX floors when I was a teenager. And that progressed into me becoming the youngest trader on the floor at the age of 21 on the COMEX floor, and then eventually the NYMEX. Developed a business there, really learned a lot about trading and a lot about life, and that kind of formed pretty much everything going forward. I built technology companies at the age of 36. I sold my technology company and became the CIO of New York Mercantile Exchange, the NYMEX, which is the world's largest energy exchange. And at the time, it was all open outcry and very technophobic. And I led the transformation of that company from open outcry to electronic trading, right-sized all the technology, et cetera. Then became the CEO of NYMEX Europe for 2 years, went to London, learned a lot about European regulation, markets, et cetera. Came back to be the EVP/COO of NYMEX and led the $9 billion CME NYMEX merger in 2008. So that seems like a lifetime ago, which I guess it was. After that, I became the CIO at FINRA for 2 years, Financial Industry Regulatory Authority, world's largest regulator, where I right-sized a 3,000 person organization, a technology organization that actually lacked a strategy or a vision, had large budgets and large overruns, et cetera. So we right-sized that. All along the way, my career is kind of populated with these being at the helm of organizations that are in the midst of a paradigm shift. So after FINRA, I built my own hedge fund. I decided I want to go out on my own. I built my hedge fund. Eventually, it was called Katana Financial. Katana focused on VIX futures from my background on a trading floor, trading both options and futures. And we focused on VIX futures, and within 2 years became one of the largest players in VIX, trading upwards of 10% of daily volume and dominating some of the core ultra low latency, high frequency trades. I wrote every line of software and code myself, and that was the purpose of me building this company, which eventually became a hedge fund. We had a few notable investors as well who were pretty satisfied with trading through some market crises, most notably Volmageddon in February of 2018, and the pandemic, most notably in 2020. I started trading crypto. We were the first market makers on CME's ETH and Bitcoin futures contracts in late 2017, 2018, if I'm dating myself correctly. And I dabbled in and out of crypto for several years. In the early 20s, post-pandemic, I really wanted to get into crypto. I met a lot of folks in the industry, including the folks from FalconX, the folks from Block Tower. I started to go around a little bit, but then I was straddling both worlds, right? I was trading energy arbitrage, I was trading some crypto, and it just kind of felt like I was missing this generational opportunity. And so in 2024, I had what I call my Cortez moment, famously or infamously, my Cortez moment, where I took all that software that I wrote and I sold it. And this, to me, likened when Cortez came to the New World, the first order that he gave to his men was to burn the boats, signifying that there was no way back. So I burned the boats, I sold my software, and I went full into crypto. And in 2024, I became the co-portfolio manager at Block Tower, running the directional flagship fund. And post their sale to Arca, I was reacquainted with all of my friends at FalconX, and they introduced me to a really interesting individual, Shiliang Tang, who's the CEO at the time of a company called MNNC. And we got together and we kind of hit it off. We think very much alike. Shiliang also has a background in volatility, systematic, and MNNC is one of the preeminent market neutral systematic funds in the industry. And they were expanding to create a directional fund. And so I came on to be the CIO of Directional Fund in late May of this year.
Liang's been on the show. I think we've had him on the show.
Yes, you have. Yes, you have. And it's just been a really real breath of fresh air. Everybody here thinks the same way. The same way we think together in terms of technology, how we approach markets, the use of quantitative methodologies to back up almost everything you do. And so our fund is very different. Our directional fund is very different than most others in that we are systematically based, but I use that 35 years of experience as a discretionary overlay in some cases. We heavily rely on convexity to express directionality as well as to harvest yield and to really own convexity.
So let's talk a little bit about that. So, because obviously I'm an options trader as well, right? So I'm a big fan of having convex products in the book, right? So, they're kind of, whether it's for hedging purposes or whether it's to get some leverage to a move and things like that. So how do you, so you mentioned you want convexity, you want positive convexity in the book generally, right? But then obviously that generally convexity costs money, right? It costs you don't earn a yield to be long convexity, right? So are you saying sometimes you go short, sometimes you go long, or you always want to be long convexity, but sometimes you find smart ways to fund it using short dated options or something like that?
Yeah, so both, right?
Okay.
But for instance, it really depends on the market regime. And I think we're going to talk about volatility realized premiums in a bit. And I really focus my convexity bent, if you will, or my convexity lean into where volatility realized premium is. And so right now, for example, I am in a short gamma, short theta, short vega scenario in our options book, which essentially I've told our investors, and I tell anybody who wants to listen, that I always carry this quiver full of downside convexity, like downside protection. Most directional funds actually don't do this. They kind of just punt and whatever happens, happens. But I really believe if not for monetizing the downside, protecting your assets. You're a steward of your investors' assets. So on the downside right now, we are basically long near the money puts and short some of the wing vol, some of what I call panic vol that's going out. So think about Ethereum, for example, which is one of my favorites to trade right now because of the volatility profile, right? We're going to talk about Bitcoin, how Bitcoin's vol has been compressed over the past year or so. And while Bitcoin still provides us with really good opportunities and ability to express directionality, I favor Ethereum's volatility structure right now because, you're getting some wing vols as high as 85, 90% in some cases.
So you like being long the closest to the money and short the wings as like a ratio structure?
Yes, exactly.
Okay. But then what happens, that gives you some break evens like that are quite far away, but you're still short Vega on that tail. So like, what do you do to address that?
So we do a couple of things. I'll delta hedge to the extent that I really don't have a strong directional bias or view at that point in time. If our data is not telling us that, hey, this is a really good time to be long or short, then I'll basically delta hedge, leaving myself with some directionality. And I generally pick strikes, quite frankly, as a directional fund. I have this luxury, right? So we're not a vol fund. As a directional fund, I have the luxury of being able to pick strikes where I'm okay being long. If the worst thing happens, I'm okay being long Ethereum at 2,800 or 2,400 or 2,300.
Because you might have some dry powder where you're happy to just take delivery, essentially.
Another core tenet of my portfolio construction is I always carry dry powder.
Yeah, it makes sense. You mentioned the data that you're looking at tells you want to be long or short. So what kind of data do you care about to determine your directional view?
Sure. So from a directional standpoint, we have built, MNC, as I mentioned, we run 3 funds here, a directional, and then 2 market neutral funds, market neutral dollar, market neutral Bitcoin. And the market neutral funds have been built on a technology platform that's been well tested for nearly a decade. What I've done with our CIO who runs directional, Boris Ayutin, is we've gotten together and we're now broadcasting signals internally that used to be shorter term signals, but we've lengthened the duration here. So things like momentum, things like moving average crosses, et cetera. Things like open interest specifically, pardon the pun, interest me because they're really good for my futures days. They're really, really good indicators of market directionality and positioning. And then you combine the transparency of a blockchain, for example, with open interest and with volume, and you can get a really, really good picture of where we're going directionally. And I'm sorry.
So do you track like the gamma positioning of the street and things like that? Do you find that to be?
Yeah,
you do. Do you find that to be quite sort of important, like, or predictive in any way, or like how useful do you think that information has been?
On a scale of 1 to 10, it's probably a 5. I think in terms of usefulness, it's just another data point that, when combined with other data points, becomes more useful because the max pain, if you will, or the street gamma is interesting for us, but won't really kind of influence my positioning, if that makes sense.
Okay. Yeah.
It's an interesting touch point because the market will tend to gravitate towards those levels. And so from there, I can extrapolate, but I'm not going to use that as the signal, if you will.
Yeah, that makes sense. Yeah.
It's a feature.
Sure. So, you talked about the Bitcoin vol compression. I mean, it's been impressive. Obviously, we had a little bit of a bounce recently back up to around 50 odd. But this thing got down to 30 vol, right? I mean, it was like,
it was in the low 20s for day aheads, right?
Madness.
You're telling me that Bitcoin, which is a quote unquote hyper volatile asset, is getting the same volatility as the S&P, or in that same range. I mean, come on. But I mean, for a while it was there. I mean, if you look at VRP and how it kind of just plateaued and flattened out for a good period of time this year, for a while it was there. But
So VRP, for people who don't know, variance risk premium. Yeah. And it's just the difference between implied and realized volatility, right?
Correct. Implied vol minus realized vol.
Yeah, so then how do you trade variance risk premium? Is it a case of when it's above zero, you're a seller of gamma, and when it's below zero, you're a buyer of gamma? Is it that simple, or is there a bit more to it?
There's a bit more to it, but at a high level, yes, it's pretty much that simple. My thesis is probably not any different than your thesis, is that positive VRP basically is the normal case, if you will, for most assets and most asset classes. So when implied vol is higher than realized vol, it indicates that people are buying insurance. And generally, people pay more for insurance than they should. And so therefore, I want to sell that insurance.
Yeah, I mean, exactly. The systematic way to be generally involved is to sell the insurance, right? Sell the expensive options, and the positive VRP is just kind of giving you that confirmation in the data that yes, vol is a bit expensive relative to realized. I feel like on the flip side though, sometimes, a negative variance risk premium is like enough to make me want to buy vol, but it's much less frequent, because there'll be times where recently, like market sold off and vol popped, and then when the market bounces and vol comes down and it overshoots a bit and it goes below realized, because the realized has been quite a high both on the way down and on the recovery, you've got a high realized vol and you've got actually quite a low implied, because the implied is already kind of reflecting the bounce and the fact that things are going back to normal. You got to sometimes be careful that actually that drop in implied is just leading the realized, because the realized is likely to come down. So I'm not going to buy a load of gamma here at this negative VRP, because it's not necessarily stable, right? It's much more stable when it's positive, generally, I find.
Correct. Except it's been stable for quite a bit this year. It's been negative for quite some time. If I look at one of my charts, VRP has been negative since I'm going to say the end of May, until we crossed in the middle of August, and then it went negative again to October 10th, right? So, what does that tell you? It tells you exactly what you just said. So you had this period of time where we came out of the post-Trump tariff tantrum, if you will, and the market sell-off, and the resulting market sell-off that actually crypto led. And we came out of that, and it signaled this whole new bull run that came on. And as the market is going up, what's happening? Well, you have greater institutional participation in Bitcoin this year than you did last year. And these institutions, digital asset treasury vehicles, Metaplanet is like the hugest at doing this, right? Digital asset treasury vehicles, ETFs, whales who've held for a long time, or just long time holders. We see this in our Bitcoin fund. And they just want to write calls, right? They just want to just write calls. And it's been relentless. And that's driven that VRP to be negative for most of the year up until about now, right?
So the trade's too cheap, basically, because of that.
Yeah, and like we were talking about this earlier, right? But vol's trading cheap, but the market can remain irrational longer than you can remain solvent. So it's trading cheap, but it's trading cheap for a reason. Typically, negative VRP, volatility implied lower than realized, would be you'd have a positive EV on most long gamma, on most long premium, right? Long options. But in this case, it wasn't really so, but it was also super difficult. We had these conversations internally. It was super difficult to really get out there and write volatility, sell volatility against some of your options. It was really difficult from a rationality perspective, but we did it. And it's all about, as the market matures, you're picking your spots more. So when Bitcoin normalized vol was 60%, which was like a year ago, right? Now it's 40%. As I say, 40 is the new 60. But when it was 60%, it was much, much easier to figure out where and when to sell options, right? Because you can justify that a little bit, because okay, so if the normalized option was, if the at the money options 30 days was 60%, your near terms might dip into the 50s, etc. But you could rationalize selling 65, 70 vols on the wings. Now you've got volatility smiles and term structures that are basically flat because of all this forward call overwriting. And it just becomes really, really difficult from somebody who grew up on the trading floor trying to avoid picking up nickels in front of a steamroller. It becomes really difficult to not to actually go out and sell vol and to not just be long.
Yeah, but usually just being long is a death by 1,000 cuts, isn't it? When you are long, is there like a favorite way to hedge your gamma that you have? Like in terms of, is it a case of daily closes? Is it a break even type thing? So if we do one standard deviation, I hedge, or like how do you think about that when you own vol?
Well, typically when I own vol, how I like to hedge is I'll do it on daily close.
Okay.
Just because we're a directional fund, we have a longer term view.
But Bitcoin doesn't have a close.
Well, we use 7 p.m. Eastern or midnight UTC, right? Or as long as you do it at the same time every day, as long as you're consistent with what you're doing, that's okay too. So I've done it where when markets are volatile like it is today, remember I said generally, when markets are volatile like they are right now, we can go as little as 15 minutes on our hedges, right? Just because of the market's bouncing around. And I know that's a little inconsistent, but it's just really preventative in the context of I'm short wing vol. And so if I'm short wing vol, I want to make sure that I'm not out over my skis too much.
Okay. Yeah, sure. Fair enough. So that's when you're saying when you're short gamma, you want to stay in front of it and make sure that delta doesn't get too big against you, right?
Correct.
But what about when you're long gamma? Like, is it do you sometimes, if it does a 2 standard deviation or a 3 standard deviation move, then do you bank some of it, or do you always wait till the end of the day?
So the hardest thing to do in crypto is take your profits, and specifically in Bitcoin and Ethereum options, some of the hardest thing to do is take your profits, because when you have an explosive move, like for example, we had this summer when we went from 2,500 up to 3,500 in a matter of days, and then 4,000 shortly thereafter, we actually bought vol. Ethereum vol came into about 55 and ETH was trading about 2,500, 25 and change. And I just loaded up on vol and I didn't sell anything against it. It was one of those signals where it was just implied volatility was so low. I didn't want to sell anything against it on the curve. I was willing to actually take that risk in terms of a directional play. And all of our data pointed towards a big right tail move.
You must have killed it on that move then.
We did really well. Yes. Thank you. But what results is you're long a lot of gamma, and as the market is moving, you're getting longer and longer and longer. The market's moving up, you're getting longer and longer, to a point where the intraday swings are really affecting your P&L and your ability to look at everything else that you're long, right? So I'm not just long Bitcoin and Ethereum, I'm long some alts. And so that's affecting my overall P&L. And so what I like to do is I like to then I like to do a classic strategy of rolling up. But when I roll up, a lot of times, instead of rolling up delta neutral, I'll roll up just size for size and take some and essentially take profits, take some cash off the table.
Yeah, makes sense. Cool. Let's talk a little bit about the market, right? Obviously, we've had quite a turbulent time recently. Had that big liquidation happen on the 10th of October. And then now we're testing, not far from 90K on Bitcoin. What do you make of all this?
Sure. Well, I think a note on October 10th, we as an industry saw what would ordinarily be in any other scenario in past years would have been an existential event with a $20 billion plus liquidation day. So I think the industry in and of itself actually handled October 10th pretty well. I think it proves the case that crypto works, the technology works. And so at a high level, I'm pretty happy with that, with that outcome. I'm also pretty happy with the way that we performed in Monarch's directional fund. As I mentioned, I always have this quiver of downside convexity. Some people say it's a drag on your upside, but it's exactly for cases like this when something happens, which is never really predicted. It just kind of always happens and it's never the same 2 times in a row. we had a decent amount of downside convexity that protected our long positions. And at the same time, I was carrying a lot of dry powder into that event, which allowed me to purchase and then consequently flip tokens like Bitcoin and Ethereum and some other alts that were just that they were just getting, the baby getting thrown out with the bathwater scenario. So I'm buying Bitcoin at 104, 103, and I'm looking up and it's trading 111. How am I not trading around that? So we had a really nice trading day that day. And as a fund that was long going into the event, to come out up on the day, I think actually validates our portfolio construction.
Yeah, I mean, it's true. Like, people think hedges are a waste of money. Me and Dave talk about hedging all the time because I'm very pro hedging, and he's just like, I've just got a long-term macro view, so I'm just going to be long. I don't need hedges. So I'm just of the opinion that, yeah, whilst, I mean, I often use calls to fund it as well. So I do risk reversals a lot. And then when the market kind of goes nowhere or dips, I'm very quick to buy my calls back, and they've kind of funded part of my protection, right? So that's kind of how I run a systematic hedging strategy around my own personal sort of Bitcoin stack. But yeah, big fan of hedging. I think it puts you in a position of strength when everyone else is in a position of weakness. And like you said, that's where you can step in, and basically when it's on a fire sale, you buy some and you can flip it 10% higher in no time, right?
Exactly. Look, somebody once told me, who I used to refer to as the all-knowing individual, that if you're putting a hedge on, then you're not confident in in your expected value and in your projections in the market, so you shouldn't be in the position in the first place. And I just kind of say, well, except for this particular all-knowing individual, if you're right 100% of the time, that works. But if not, everybody else needs hedges.
Yeah, I mean, I will say is, if you have hedges, you should have a game plan on how to monetize said hedges, right? Because I definitely, in my time in TradFi, I spoke to a lot of clients and I saw a lot of clients trading, hedging their books, but they just never did anything with those hedges when they were massively in the money, right?
Yes.
They were rabbits in the headlights, and that's not the right way to kind of trade, I don't think. I think if you're putting hedges on, you need to know, right now in this market environment, this type of hedge makes sense, but market down 20% and vol a hell of a lot higher, I'm rolling my hedges, I'm monetizing them, I'm restructuring them, I'm doing stuff with them. So there was a point in having them in the first place, right?
Yeah, this isn't a passive fund, so we view it the same way. As I said, it's the most difficult thing in crypto to do is to take your profits. So, for example, if you're short a bunch of ETH perps against your core option position, right, and an ETH drops. This is a great example. It's happened during the summer several times, right? And ETH drops a couple of $100, and vols are coming in to offset that. I'll take my hedges back in and essentially apply that gain to my cost basis, right? I don't look at it as a trading gain. I look at it more of a cost basis reduction plan.
Yeah, and then you're happy to just sit long the ETH that you've got, right?
Yeah, wait. Markets move, so you just wait if you're patient.
Is this sell off? I mean, are you buying the dip yet, or do you think this thing's got legs? Can you tell us?
Yeah. So let me just give you a few stats on this particular sell-off. So a lot of people right now are talking that the cycle is over and that we're in a bear market. I'm going to politely disagree. I think the bull case is still intact for owning a fixed supply, permissionless, decentralized asset like Bitcoin, for example, right? Like most crypto in general. But institutional adoption is still strong. Funding rates and other internals are constructive. Structural drivers such as asset tokenization of stocks, bonds, real estate are going to continue and push the cycle, in my opinion, to top early to mid 2026. So I don't think we're there yet. A lot of people are talking about this setup that's going on in Bitcoin right now, which is we've had a death cross setup. So for your viewers, a death cross happens when the 50-day moving average drops below the 200-day moving average. And traditionally, it's viewed as a bearish technical signal indicating weakness and short-term momentum failure. So okay, so in ordinarily you'd probably say this is a sign that the bull market could be over. But this is the fourth death cross since the 2023 cycle began. And the prior 3 death crosses coincided with major local bottoms. So in each case, Bitcoin bottomed just before the death cross formed. Current price is around right now 92.5. So a similar pattern could be forming. I do believe, though, from my experience in markets always test psychological levels, and I can't imagine that we're not going to test the $90,000 level before getting some sort of resolution one way or another. So from that perspective, long term, still bullish. Short term, we are in our portfolio is constructed in a protective mode right now, as the aforementioned 1x2 downside puts that we've got. And they're essentially funding a lot of right tail convexity that I've just rolled completely down. And when or if the market bounces again, we'll be in a good position either way. So from Monarch's position, we are essentially waiting for something really big to happen in the market in a kind of sudden way. So whether we go and test 90 and then into the mid 80s, I think that's probably a decent spot to start layering in some longs again. Or if we establish a bottom in the low 90s and then go back up, your $100,000 mark is going to be the next test.
Yeah, it definitely feels like it's going to be interesting. And there's going to be tons of opportunity, but you'd rather the market actually did something and moved around, so there's actually stuff to trade, right? So
yeah. Oh well, when you're harvesting vol, it's not so bad, right? So right now we're getting paid to sit around, which isn't bad.
Let's talk a little bit about how the market's been evolving, right? So obviously we've talked about the vol compression, but in terms of like where the volume is, we had Deribit had the market sewn up, right? And then along came IBIT, Instos came in, got involved. Now they can have, a US listed product with dollar margin available, and volumes have exploded to the fact that they're kind of like 50-50 now. What do you make of that?
So a lot of people would point and say that Deribit has lost market share. What I say is that the pie has essentially doubled in the last year. Overall, Bitcoin options market size has doubled. IBIT open interest is now exceeding Deribit's in Bitcoin terms less than a year after launch. Think about that for a second as a sign of, it's really reflective, if you will, of the extent of institutional adoption and convergence of crypto and TradFi. Because if you're an institution and it's really, and you want to hedge your ETFs, your DATs, you just want to express some directionality, it's super easy to do this with IBIT options. I do think that some of the negatives there, which I think is why a lot of crypto native traders, hedge funds, institutions are not migrating to IBIT options. So you see this robust trade between the two. A big reason why is IBIT's not open at night or on weekends, right? So the market October 10th was a Friday evening after the markets closed. And so there is a possibility. I always talk about this internally here because we talk about this kind of cross asset vol trade that I really want to do. But some of the limiting features are exactly this, where you could theoretically on the night of October 10th be liquidated on one of your legs or have to get out of one of your legs, but you're not unable to get out of your IBIT side or your TradFi side. Right. And so you're locked till Monday. And it's kind of like this perfect storm that happens where we used to see this in VIX a lot of times where before the actual stock market would open, people would take VIX positions on like a Sunday night if there's a large move imminent, and they'd essentially get stopped out on both sides. There's certainly a risk there. So I think that from a traditional crypto standpoint, you want to be trading on Deribit. I think that just in the context of you don't have dollar collateral risk, but by the converse is at institutions like here in the United States are going to say, well, I don't have crypto risk and I don't have to worry about wallets and keys, et cetera. So I think these are two very healthy and robust markets, and they're going to continue to be so. And it's great to see.
What do you make of all the zero DTE volume that's trading? Because that's gone nuts as well, hasn't it?
That's gone nuts. It's kind of like, I call it options crack. Zero DTE. It's great if you're a market maker. It's a horrific product if you're retail. If you look at the stats on that, retail gets absolutely decimated by market makers in that zero DTE.
On crypto or everything, do you think?
In general, everything. Yeah.
In general. Okay, interesting. Yeah, but it's like 50% of the market. It's crazy. It's 50% of the volume, right?
I know.
It just turned into a casino. Have you got any thoughts around VIX and how like crypto markets compared to the VIX? Because you were very well versed in how the VIX traded and stuff. Is there any insights you have there for us?
There's a huge similarity in that obviously volatility tends to be mean reverting, but again, that old saying about the market, the market can remain irrational longer than you can remain solvent. So just be careful there. But from the perspective of the two markets, I've actually developed a model where I look at VIX versus DVOL, for example, and there are very definitive trading bands that you can trade off of there, and that you can measure relative cheapness or expensiveness of one to the other.
Nice. Okay, so there's some stability in that relative value, is there?
Yes.
Okay.
And then when it gets out of line, that's not a bad place to be long or short. Now I don't know which one to go long or short, so generally that's more of like a pair trade where you want to be long DVOL and short VIX or vice versa. But a lot of times, if you see that, for example, and this is not investment advice, I have to say that because
nothing is on this podcast.
Nothing in this program is investment advice. But for example, if I see that historically, when that ratio DVOL to VIX drops below 2, historically, that's been a really good time to own BTC Convexity.
Okay. Below 2. I mean, it got like you said, it got close to like 1, didn't it? Which was insane.
Well, yeah, that's in the near term, near dated options like the day aheads and a couple of days ahead. DVOL is generally going to be more like a VIX sort of measure, which is about 30 days out.
Yeah, exactly. Okay, very cool. All right. Any sort of closing market thoughts for us, or any little anecdotes or stories you want to share?
Sure. Well, what I want to do is I want to give a little trade idea of the day, because we talked a lot about some of our positioning, but I want to give you this concrete example of how we at Monarch think about the downside specifically, because it is topical given that the market is on the downside. So again, not investment advice. This is an example. This is an actual trade that we did, but not investment advice. As I mentioned before, I was really favorable to protecting the downside, but I did not want to get killed by theta bleed, which is theta is the time decay of the options. So in constructing the following trade, we've developed software internally that essentially scans the market and gives us the best opportunities given a whole range of inputs, including duration, is it a volatility trade? Do you want to do ratios, etc.? And you can put a whole bunch of parameters in, get yourself the recommendations, a whole page of recommendations as to what you should do. So I chose reference price of Ethereum 3,500 a couple of weeks ago. I chose the 3,300, 2,800 bear 1x2 put spread. And this particular position will give me short delta, short vega, short theta with a tactical downside convexity harvest, which is kind of a fancy way for saying that I'm putting the spread on at a credit and I'm getting paid for it. And we've got to just manage our downside. So why did we do this? One, Ethereum typically has extremely rich downside skew. As I mentioned before, compared to Bitcoin, you're talking sometimes as much as 2x volatility. So deep OTM puts trade at what I call panic level vol, even in calm markets. A 1x2 put spread buys near the money puts, what I call rational vol, and sells twice as many deep out of the money crash puts or irrational vol. This structure monetizes fear instead of paying for it. So it performs best in the most likely decline scenario, in our opinion, ETH dropping from the top of the range at the time, which was 3,500, into the low 3,000s, high 2,000s, which is kind of where we are right now. So we are monetizing as we speak. In this zone, we're long gamma, short delta, and we've got instant responsiveness to liquidation-driven sell-offs or sharp downward spikes that we tend to see in Ethereum. And so what does this structure do? It lets us monetize vol panic rather than overpaying for protection, and also offering our portfolio a decent amount of downside protection to levels that we favor in terms of potential entry. The trade's cheap, we're getting paid, and we're carrying tactical downside convexity. So to sum it up, we're harvesting overpriced crash vol, carrying the trade cheaply, and positioning for realistic, high probability downside moves, not the asteroid hitting us scenario. So that's the kind of...
Is there a level, is there like a level that it needs to break below where you say, okay, all bets are off, we need to fly off the structure and just kind of contain it because what we thought was a sensible, realistic move is now turning into a shit show?
Right.
Like is there, how do you think about that?
So if our assumptions here are falsified, meaning we're going significantly below 2,800, the 3,300 to 2,800 puts will give us a decent amount of downside there in terms of cushion. So we can use a lot of that P&L to cushion ourselves on the downside. I would think if we're breaking 2,300, we're going to basically say something's really wrong here. Or the market, the market is just crashing at that point. Do we want to be long at effectively 2,800? And so we might take that into inventory as a directional fund. What I like to say is my investors also pay me to digest risk.
Yeah. And then what sort of maturity are you using for these type of ratio structures?
So these are in the December tenor, December 26th tenor.
A couple of months, basically.
Yeah. You want to do it a couple of months out because it gives you the best kind of balance between vol harvesting, decay, and also on your long options, you don't get as much decay. So you don't get as much of that front end bleeding off. Yeah,
perfect. Amazing. Thank you so much for sharing your insights, giving us trade idea as well. We don't have many guests come on and actually give trade ideas. So that's a bit of a treat. Appreciate that. And
again, not investment advice.
No, of course
it's just an example of how we think here at Monarch about protecting downside.
Yeah, it's more for educational purposes. I mean, that's what I do as well, right? None of my stuff is financial advice, but we are trying to educate the masses about options and what they allow you to do, and that's just another clear example. Absolutely. But I really appreciate you.
Podcast.
Yeah, appreciate you coming on the show, and take care of yourself. Cheers.
Thank you. Thanks so much.
Probably interesting conversation, timely one. In terms of, I mean, you're always saying to me about hedging and my downside hedges, which I don't do enough of. But
yeah, and he's got an interesting, different way of looking at it, right? He uses that expensive left tail wing vol. He's using that as a funding leg, basically, which works as long as you strike that structure quite far to the downside.
Yeah.
But if you blast through those shorts, then you might have a problem. So he has to be a bit more active with the way he does his hedge. But then the good thing is it doesn't bleed as much as well.
Yeah. No, interesting. No, I wish I'd been a little bit more hedged into last
month. It's one of those, like, it's time horizons. It's like when it's your own money, drawdowns don't matter as much to you. If it's not like your entire net worth, you can kind of sit there, close your eyes and be like, I'm playing the long game, right? And that's a lot of people are using these dips to dollar cost average into.
Yeah, I mean, my annoyance, like, not being, and I've got no excuse because I'm sat next to you every week, like telling me about hedges, and I'm like long-term macro, like I've got no, like, Bitcoin's like just like inevitably is going higher. All assets will go higher in fiat terms, right? There is no stopping that train. But so then you kind of, I'm always an advocate of, you want to like dollar cost averaging where you can. The whole brilliant thing about the downside hedges is that you're able to monetize those to give you the cash to buy the dip. You get the protection, gives you the cash, and then that's where I can buy the dip. Like right now I'm looking under the sofa and everything to try.
There's nothing there.
Because I'd happily buy this dip here. Like there's no like here 88k, whatever.
Yeah.
Sure. It's a good opportunity, I think, to get long. But yeah.
I mean, for having hedges in place forces you to be a bit more active, forces you to think about monetizing on dips and stuff like that. I mean, it's not like I think the reason why maybe you shy away from it is because you don't want to have to overtrade it, basically. Right?
Yeah, exactly.
And you also don't want to find yourself in a situation where we rip higher and you give up your upside, and your long-term thesis has always been this stuff only goes higher. So why am I trying to be cute with it? So I sympathize with that. But the way I deal with that for myself is I never hedge all of it. I only hedge a percentage of my Bitcoin, and everything else is just always kind of long only, right? Yeah. You know, one last thing I would say is on this dip, you know, I've talked about call ratios as a way of defensively buying the dip when the vol pops, and another great entry point for Ethereum to do that again. I did some more of those today.
So what are they then? So
that's December. I use December. So you need you don't want to go too short dated like November, right? Because you won't get really any premium for those upsides. But end of December, so around Christmas expiry, something like a 3600, 4100. Buy the 3600 call, sell 2 of the 4100 calls, get in there for next to, well, not zero, but like $20 or something. But if that thing goes to 4,000, it's worth $400, right?
Yeah.
You know, by Christmas, and you spent $20 for it.
Yeah.
So that'd be a 20-to-1 payout if it kind of gets there, right?
Say altcoin like returns.
Yeah. I mean, obviously there's a path, right? These ratios, they have a path. They don't just, if it goes there tomorrow, you're not going to make any money, right? But the idea is if you zoom out a bit and say, okay, if we're going to chop a little bit, we're going to put in a bottom at some time in the next couple of weeks, and maybe by Christmas there's a Santa rally on risk, and we can get ourselves back to somewhere towards 4,000 on ETH, then you've got a nice little Christmas present, right?
Yeah.
So
let's hope for that.
All right. Well, that's what I'm hoping for. All right, guys, we're going to leave it there. Remember, like and subscribe, and we'll catch you back here next week. Thanks for watching.